All right, welcome everyone. Thanks for tuning in to this episode of the Hawaiʻi Retirement Show. Super excited and honored. We have a special guest on today. We have Dr. Trey Spilker of Shidler's College of Business, UH Manoa. Thanks for joining us, Trey.
Glad to be here.
Awesome. And I wanted to start things off with reading your a little background write up from Shidler's website because I think it's very impressive.
Sure.
So I want to take a second to tell our listeners a little bit more about you. So this says his research focuses on the social networks of institutional investors and their impact on portfolio decisions, performance measurement of alternative investments, and the evolving role of passive investing within active mutual fund families.
hmm
His work has been published in leading academic journals such as the Journal of Financial Economics, Journal of Financial and Quantitative Analysis, and the Journal of Banking and Finance, and has been featured in media outlet including Bloomberg and Institutional Investor Magazine. Professor Spilker teaches across the undergraduate and master's program in the areas of investments, portfolio management and optimization, financial derivatives, and risk management. He is widely recognized for his teaching excellence. Before entering academia, Professor Spilker advised institutional clients on hedge fund portfolio construction at Cambridge Associates and K2 Advisors. He conducted equity research at UBS and managed public equity investments at Terrapin Creek Capital, a family office. Earlier in his career, he held financial roles at Harvard University and General Electric and served as an F-16 crew chief in the U.S. Air National Guard. He holds a PhD in finance from Boston College, an MBA from the University of Maryland, College Park, a graduate diploma in management from Harvard University, a bachelor's of science in finance from Virginia Tech, and lastly, he is a chartered financial analyst, CFA holder, and serves on the board of the CFA Society of Hawaii. Very impressive.
Indeed.
Trey, I'll turn it over to you if I missed anything. And maybe if you can tell us a little bit about yourself, personally as well as professionally.
Yeah, sure. I mean, obviously that covers the bulk of it. I've never had my bio read to me. It's a kind of a weird experience. But nonetheless, so yeah, that's sort of my entire professional background in a nutshell. I live here with my wife and two girls in Honolulu. I've been here for about 8 years. I've been teaching at the Shidler College for about that time period. Yeah, outside of that, I have some hobbies here and there, but with kids and a full-time job, it's hard to pursue any of those, right?
Sure,
So,
sure.
when I can, I play guitar for the kids and I also hold a pilot's license too, but I don't get to fly anymore, largely because it's too expensive these days, right? So
Right.
putting kids through school and living here can drain all those resources.
Gotcha. And then is there I guess it just changes the courses you teach, graduate level, undergraduate, and which courses is it?
Generally speaking, I teach the same courses to undergraduates and master's students. So I teach the sort of required investments course to the undergraduates. So this is covering topics such as, portfolio theory, how to value an equity or a bond,
Hmm.
right? Sort of these decision kind of sciences for finance majors. I also teach the upper level portfolio management course to the undergrads and the master's students, right? So how to really think about tweaking or optimizing a portfolio
Hmm.
using, some basic portfolio theory, sort of an applied approach where they run portfolios, mock portfolios on the side. I
Hmm.
also teach the derivatives class consistently to the master's and the undergrad students as well. So teaching them how to value a futures or trade a futures contract, for example, and options, right? So calls and puts from a couple different perspectives. The perspective of sort of a hedger, right, which is typically how most derivative securities are used in the corporate world. And then also as a investor or a speculator, right? Trying to
Sure.
make calls on the market, as it were.
Yeah,
Yeah.
very interesting. That's finance is such a broad field. There's just so much there, and that I,
Indeed. Yeah.
I looked over the kind of the CFA curriculum and
hmm
everything there, and man, what an undertaking, even for a really
It is.
really smart person. It's quite the undertaking. Just the
It
breadth.
is. It is a labor of love, or, depending upon how masochistic you are, a labor of pain.
Right.
Yeah, no, it's I call it the practitioner's PhD. I think it's as comprehensive in terms of breadth and
Mm.
depth from the perspective of a practitioner largely in the institutional investor landscape, right? So for professionals who want to signify that they're really, really focused on asset management or institutional sort of investors, right? So it's distinct in many ways from a CFP, which I understand you hold as well.
Mm.
That tends to have more emphasis, the CFP having more emphasis on dealing with individual investors who have much more complex financial situations. You have to deal with primarily taxes,
Sure.
retirement, and
Right.
estates and trusts and stuff like that that most institutions don't really have to worry about.
Right. Yeah. No, it's a good distinction. And, the alphabet soup of financial professionals,
Hmm.
at least, well, from the analytical side, analysis side, there's the tried and true academic route, the PhDs
Sure.
and the CFAs. And it's a lot more clear when you get into my space of the financial advising. The number of credentials just seems to grow infinitely, and some of them the value I don't it's really hard to parse it. I don't know how consumers go about parsing it really.
I don't either, to be honest with you. And I feel for them. I mean, frankly, even as a learned professional, when I see, particularly like on the insurance side or the estate planning side, there's a lot of acronyms. I just have no idea what they are, right?
Yeah,
And what level of professionalism that signifies, you know?
sure. Yeah, it's a challenge. It's a challenge that I try to work through and convey, but CFP seems to be the gold standard for now, at least for the financial
Yeah, I think
planning.
that's true. CFP for investors and then CFA for sort of institutional investors for sure.
Sure.
Yeah.
Um, okay, to kick things off here, I know you recently co-authored a paper. You had a work, believe is entitled Private Equity Fund Performance, a Time Series Approach. So, without going too far over my head on an intellectual level, can you tell us a little bit about that?
Yeah, I think it might make some sense to step back a little bit before I discuss that paper because there's so
Okay.
much sort of institutional knowledge that is sort of required to interpret that paper. I'm not too familiar with how sophisticated or, in terms of, the products that your clients might invest in. How
Sure.
familiar are they with private markets in general?
So that's a great way to kick it off, and I think you're right here that we should maybe table that for the end.
Hmm.
So our audience is, what I kind of focus on is retirement planning, and when you get to
Okay.
that stage, you really, in my opinion, and I guess another good way to kick things off is just to make the initial disclaimer: none of this is investment, legal, or tax advice, and we're not
No.
recommending anything. But once you get to retirement stage of things, even more so than the accumulation phase, you're really focused on decumulation and
Yeah.
managing risk and passive investing for stable distribute some sort of distribution strategy. And because that's what we primarily focus on, the private equity in of itself probably won't pertain to most of the listeners.
Right.
However, what I find is even things that don't necessarily pertain to you can often offer peace of mind if you just kind of understand it a little more, even though you may never go down that path. Does
For
that kind of
sure.
make sense?
Absolutely. Yeah,
Yeah.
it's good to know what you don't know, right?
Yeah, absolutely. So I guess well let's kick it off with private equity basics. And I'm going to ask you a question that's
Yeah.
far too broad that I shouldn't even ask, but so just it's from what I heard, private equity is now a $6 trillion industry. I'm sure that number
Mhm.
fluctuates.
Yep.
Can you explain high level what is private equity?
Okay. Um, it's easier to explain what it is by telling you what it's not, right?
Okay.
So let's broaden out a little bit more even. So I'm going to talk about private markets in general.
Hmm.
So this would include not just equity per se, but bonds, right? So here's what it's not, right? So what your investors are probably used to are public markets, right? So where you invest in the stock of like Nvidia or Apple or the bonds of
Hmm.
GM or IBM, right? So these are public equity and public bond markets.
Hmm.
Um, it's not that, right? So the public markets are one in which you can, watch CNBC and you can, buy the individual stocks either directly through, an online broker or through their financial advisor. Um, Private markets are not publicly available.
Mm,
right? That is, you have to go through some intermediated platform or advisor to get access to them. And it largely breaks down to the three sort of categories, right? So private equity being the largest among them, and that's very similar to its public equity market equivalent, except again, it's not publicly available, right? So these are privately held investment companies. Then there's also private credit, which has been growing lately, and sort of another bucket of private real assets, which would include real estate, infrastructure investments, even things like farmland and whatnot.
mm,
Um, so private equity being the largest of them, they all basically have the same structure. So I'll talk primarily about private equity, right? So they tend to raise money from institutions or high net worth investors that they use to take that capital to buy small businesses, private businesses, sometimes even public businesses they take private, right? So there's, call it three main categories, if you will, in private equity. There's the bigger traditional one we think of as what's called leverage buyouts, where you might, see a struggling firm and you buy the firm wholesale. And if it's public, you take it private
mm.
and you lever it up with debt on it on the firm's balance sheet and try to improve operations and then sell it some years down the road, typically, 3 to 7 years later. Um, then there's venture capital, I'm sure people have heard of, right? These
Right.
are, like your Shark Tank, and you go on Shark Tank and try to raise money from, Mark Cuban
Right.
and Mr. Wonderful. And these are for early stage startup companies, right? So still private investments, but still from an equity perspective. And equity is differentiated in many ways in that you're the last person, like you're an owner of the firm and some pro rata share of that firm.
Mm,
And you just take whatever's left over in terms of cash flows after everybody else has been paid for, right?
mm,
The third main category, which has been growing over the last decade, is something called growth equity. So it sort of sits in between venture capital and a leverage buyout, which, a leverage buyout would be more mature companies. Growth equity is sort of in this scale up phase or, a growth phase of the company. In years past, companies would start in the venture capital phase, right? And then, the private equity manager, which we'll talk about in a minute, would then spin them out through an IPO to the public markets.
mm.
There's more and more interest by these companies like Shopify or even ByteDance to stay, private, so they get more growth equity from the private markets and stay private for much longer. And you see this even now with OpenAI, right, who runs
Mm.
ChatGPT. They're still private. Um, and so those are the three main categories: venture capital, growth equity, and LBO. Now, in terms of how they operate, right? The we'll talk about a bit about the sort of the the individuals who run it, right? So I mentioned that you have institutional investors typically, who would come in. And by that, I mean like university endowments and foundations and insurance
Or
companies.
like, could it be even our pension funds, right? The employee retirement
Absolutely.
system, stuff
Yeah.
like that.
So, for example, the Hawaii employee retirement system, right? They have, something like 20% of their portfolio invested in private equity funds,
Mm,
right? So yeah, absolutely. Pensions are particularly large investors in these fields as well. So they would be the investors. They're often called limited partners or
mm,
LPs. And they make commitments to a general partner, a GP, who runs a particular fund. All right. So this might be like Blackstone, one of these major large private equity fund managers, or Apollo Group, who raise a fund from different institutional investors or high net worth individuals. And typically the buy-in to these funds is in the millions of dollars, right? So you have to commit maybe $10 million to the fund or five, something in that range, quite large fund amount.
mm,
And what the GP then does is invest that money typically over the business cycle. So the money is committed over roughly a 10-year, on average, time period. So there's essentially no liquidity when you commit to these funds.
right.
So that's one of the downsides, but that's also one of the upsides in that, by locking up your capital, you get what's called sort of a liquidity premium, as it were,
Mm,
right? So you should expect to receive more, right? No risk, no reward, right?
Sure. Sure.
So that's true also in terms of locking up your capital. So they'll, do their best to find the GP that is, will then go do their best to find underlying small firms or medium-sized firms to essentially improve their operations over time. So they buy the firm, improve operations, and then hopefully exit that firm through a sale to the private market or take it public potentially, or even sell it to a strategic, meaning like to another public company already, right? And that typically takes, 3 to 7 years through the sort of business cycle. Um, and so what's unique about this structure is that the institutional investor and the high net worth individuals who commit this capital, let's say you commit $10 million to a fund. Well, you don't actually hand over that $10 million on day one, right? The GP still needs to go out in the world and find good investments.
Mhm.
So over typically the first 3 to 5 years of the fund's life, they'll occasionally call and say, "Hey, we have a great investment we're going to make. We're going to call 1 million of those dollars that you committed." So it's at that point in time where you actually fund it. So one of the great challenges to investing in these funds is that they have to, account for the fact that you might get a call any day of the week, right? And you have to fund that commitment over the next quarter. So it can be challenging from a cash flow perspective. Um, and so they go, hopefully, make good investments, and then on the back end of that, you'll see all your payoffs, right? So typically, you'll see all these drawdowns in the early part of the cycle. So you see only negative returns on your your
Right.
balance
Right.
sheet, but then over time, over that 10-year cycle, hopefully those improve. And it's very similar in many ways in private credit markets, except instead of investing, you're taking an equity stake, you're actually making loans to companies, right? You're
Mm.
making loans to middle market companies that maybe not large enough to get preferential bank loans, right, from your traditional lenders,
Mm.
or even access the bond markets. Maybe they're too small for accessing public bond markets, that is to issue a bond. So there's many reasons that those funds exist. Um, and then, of course, there's like as I mentioned before, the real assets, right? So investing directly in real estate.
Right.
There's specific funds that do that as well.
Okay. So there's a lot to unpack there, and
Yes.
that's due to me asking such a broad question. I want to kind of touch on a couple things there. So as I understand it, so there's it's access to high net worth, institutional investors. However, can the average retail investor access this on a secondary market through buying shares of a private equity firm, not directly investing?
Yeah, so traditionally, no, right? Traditionally, you have to be what's called an accredited investor.
Mm.
Basically, you have to have something like north of $1 million net of your personal residence and make a sufficient amount of income. I think it's two to $300,000 a year to get direct access.
Mm.
So to your point, retail investors are not keen necessarily to
Sure,
be
sure, right.
committing $10 million to one fund. The other issue, of course, is that, how does the retail investor have the ability to make that decision on which fund to buy, right?
Mm.
So there's some reasons why it's actually a good thing that investors are protected, frankly, from investing in something that's rather opaque, right?
Mm.
Um, but to your point about secondary markets, so um, because private markets are private, they don't have this like exchange mechanism we see in public markets where you can just hop on your brokerage and trade shares, right?
Right, right,
Um, so there has been a growing market over the last decade, particularly since the global financial crisis, where there were a lot of institutional investors who were caught with all these, commitments, right, and wanted to get out of them. And so it's been growing since then. And secondary markets just means it's an ability for these institutions to sell their stake in these private equity funds
Mm.
to other interested buyers. Right, so it creates liquidity, if you will, in the market. And so, other investors can get access to, say, the best fund from Carlisle if, for example, the Princeton Endowment, who's facing some political pressures these days, right, to get
Right.
rid of some of their to reduce the endowment size to pay some potential taxes, right?
Hmm.
Um, so they'll sell it through a secondary market to potential buyers. And for example, I know Blackstone, has a pretty large secondaries fund where
Hmm.
they buy lots of stakes. In fact, I think the New York City pension system just sold a $5 billion stake through a Blackstone vehicle
Hmm.
in their underlying pension or private equity investments. Um, and then of course Blackstone then has this fund and they can offer it out to other investors. From a retail perspective, right? Do they have access to that? It's going to depend on the investor. And that's, more of a technical question, depending upon the kind of fund they're looking at. But for this is what they call an interval fund, right? So interval funds are what are similar to closed-end mutual funds,
Okay.
um, which are available to retail investors. So interval funds are one way to access private equity through the retail channel.
Hmm.
Uh, Frankly, you can also buy the public equity of private equity firms
Okay.
such as
Right.
Blackstone, Apollo, KKR, Citadel, these kind of firms who have public equities. You can invest directly through, these markets, the public
Okay.
equity markets. In fact, there's even ETFs that are investing in the fund, the stocks of those
Right.
particular
Right.
companies as well. So there's these sort of, the public market access you can have to those firms. There's the private market access through interval funds. There's also access for retail investors through business development corporations, BDCs,
Hmm.
which trade also like a closed-end mutual fund. And these are companies that essentially issue loans, right? So these would be private credit to firms that retail investors can also have access to through the BDC structure as well. So there's a couple different ways that retail investors can get access to private equity, right, through sort of interval funds, ETFs, and the like, and then private credit through these BDC, business development corporations.
Okay. Interesting.
Yeah.
And so, with these institutional investors, or anybody, anybody available that's able to invest in these private equity firms, there has to be a ton of trust here
Mm,
because, from my perspective, and again, I focus on passive investing, that kind of thing. You're committing, you're really committing yourself, like you mentioned earlier, and uh, and I'm just curious the likelihood of success there, it has to vary just as any investment, right? I mean,
yes.
the reason you invest in a company, stocks is you expect a return, but then there's the risk, there's always risk involved, right? And so
Indeed.
it seems almost that commitment and the level of risk seems a little amplified when you're heading into this private equity. Is that fair to say?
Yeah, I think that's very fair to say. I mean, just overall in the finance industry, it's heavily dependent on trust to begin with, as you well know,
Yeah.
right? This is especially true when you're going to be engaged in a long-lived relationship,
Mm.
right? Either with a financial planner, right?
Right.
Or in this case, a GP LP relationship, right? Investing in a private equity fund because it's sort of a minimum of a decade, right? So yeah, there's a high level of trust that has to be built up over time. So large institutions spend a disordinate amount of time
Right.
analyzing the general partners, these private equity fund managers, not only their past successes and failures, but also personal backgrounds, their histories. So there's a significant operational infrastructure that institutions either have in-house or they, outsource to a company like my old firm, Cambridge Associates. That's what we used to do for pensions and endowments on the hedge fund side. So my job would be to do due diligence on all the hedge fund managers I thought were appropriate for those particular portfolios.
Mm.
We would do the same thing also on the private equity side, right? So a pretty large infrastructure to build up that trust. And then, which, is obviously not something a retail investor can pull off.
Sure. Yeah, and so I guess that leads to it would be really difficult for how difficult is it for a new private equity firm to sprout up, right? Because you need some track record, right?
For sure.
You can't just hang your shingle and say, "Hey, we do private equity now," right?
Indeed, it is rather challenging. And this is true launching any kind of fund. If you're launching your own mutual fund or a hedge fund or private equity fund, it really comes down to the pedigree, which gets into some of my research about, where do fund managers come from,
Mm.
right? If you come through sort of the approved channels, as it were, right? You were trained at the right investment banks and you had the right education and you've been doing this for 10, 20 years, it's a much easier sell in terms of trust and conveying competence to the market and therefore raising assets to a fund than it would be, say, if, I just started a fund willy-nilly out of my garage, right?
Right, right. Gotcha.
Yeah.
Interesting.
Same way you build trust in any employment market, right?
Oh,
Like you got to
absolutely. Right.
convey that you're worthy.
Sure, sure, sure. Okay, let's talk about I feel like the barrier to understanding in a lot of endeavors, whether it's medicine,
Mm,
whether it's, finance, oftentimes is understanding the vernacular, the lingo, right?
indeed.
And I think people are more than they have the aptitude to understand these concepts, and a lot of time it's the lingo that trips them up. Uh, can you talk about buy side, sell side with private equity? Because you hear that a lot.
Yeah, well, buy side, sell side typically refers to any investment market. So you see it mostly in public markets, actually. So the sell side would be firms that are, quite literally attempting to sell you some security, right?
Mm,
The easiest way to think about this would be like an investment bank like JP Morgan, right? That's the sell side. They're trying to get you to trade through their sales trading platform or, through their team. And the sell side research equity analysts are the ones analyzing individual firms and issuing research reports in hopes to drive revenue to the firm.
mm,
Right. So that's sort of the sell side. The buy side is anyone actually committing capital on behalf of their clients, right?
mm.
So these would be your traditional mutual funds, private equity. So this would be the buy side, where they're taking capital from investors and investing directly in underlying securities. And oftentimes the buy side's interacting with the sell side to get, just information,
Mm.
typically, and they'll drive their trades through the sell side sales trading desks. So that's sort of the main distinction. A buy
Okay,
side is, s- literally buying the investments. Sell side is attempting to get the buy side to buy those.
gotcha. And then and so the way private equity, let's just like impacts the financial markets as a whole, like really big picture.
Yeah.
The way I think about it, and correct me if I'm wrong here. So you have like the whole hy efficient market hypothesis, right? And we have
Hmm.
active and passive investors. Um, Really, the passive concept doesn't work unless you have active, right? I mean, the active participants allow the passive investor to do that.
Indeed, indeed.
Okay.
Yeah. So, sorry, finish your question.
No, no, no. So I'm just curious for people to wrap their heads around maybe connecting the dots on how on just that concept of how private equity in and of itself is kind of a good thing in that it does it help sort of the passive investors through actively supporting or selling firm. Is that a good way of thinking about it or
Well, I want in terms of sort of efficient markets, at least the way you're thinking about it in terms of the theory really applies to public equity markets.
okay.
But the concept still applies to overall corporate financial markets. The idea is as follows, is that for the market to be efficient, the idea is that you have capital being allocated to its best and highest use, right? And that's ostensibly also what private equity managers are trying to do, for
Hmm.
sure, right? So if you think broadly more about the role of private markets, right? Um, they're essentially there to provide, fuel for business growth, right? So my, sister wants to start a business, she launches a website, but she needs capital to scale potentially, or she needs some institutional knowledge for distribution channels. So this is what private markets can provide. So it's really sort of a corporate finance function, if you will.
Gotcha.
How can we best help grow these firms, provide some flexible capital, right? As I mentioned, enable sort of distribution or infrastructure development for that firm. And then at the same time, those investors who have excess capital, the investors, right,
Hmm.
will hopefully have some enhanced return potential. So markets are efficient in that in a capitalist structure like we have, that prices sort of signal that efficiency. If a business seems too cheap, well, maybe it's cheap for a reason, maybe it's risky, and so private markets might have a role there to play to turn that business around because they probably have some potentially valuable assets and put that capital, the investor's capital, to its highest and most efficient use.
Hmm.
Yeah. So, and the same is true in public markets, right? More or
Right.
less.
A little bit off topic, but it kind of popped in my head here as we're talking about the efficiency of
Hmm.
markets and active and passive. AI, right, I mean, you can't turn on, a podcast or read a magazine without hearing about AI. I don't know if you can speak to this, but do you have any thought? Have you seen AI impacting, the markets and in what manner as far as, because I would imagine,
Hmm.
are they taking the place of, a traditional active investor?
Yeah, it's such a difficult question to answer because there's
Yeah,
so
I,
many
I didn't want
angles,
to go
right?
there
There's
because I
so
know
many
it's
angles
very,
to think about this.
yeah.
But if you think about AI at its core impact on society as a whole, I want you to think about it as and you see this in the name of a lot of these technologies, a GPT, a general purpose technology,
Hmm.
right? So equivalence to this would be like the invention of the train, telephone, internet, electricity, right? These are general purpose technologies that provide great productivity enhancements to the citizens of that, population. And so that's the way I think you should think about, AI
Right.
as a general purpose technology to enhance the productivity of what we do on a daily basis.
Right.
So will it impact it? Well, it already has, right? I mean, you
Right.
can see this
Right.
just in
Right.
valuations of corporations alone, right? Any
Yeah.
any company that has an AI sort of investment sees the multiples from that.
Right. And in my space here, when I'm working with retirees, people close to retirement, doing financial planning, you know, there's the analytical side, but there's an art side to what I do. Because
Absolutely.
if somebody, wants to throw a paid off the mortgage party and they love paying down debt regardless of what the interest rate is, who's to say that's wrong, right? I mean, that's what this person really values.
Of course.
But there's the analytical side. So I would imagine the same is true where AI might help, in with indicators or identify opportunities analytically. But even in a field that's so analytical like yours,
Correct.
financial analyst, there still is a sort of an art to it, right?
Exactly. And frankly, that's why I fell in love with finance and economics is that it's the blend of analytical rigor and the breadth of human behavior, right?
Mm-hmm.
And the fallibility thereof. And to be fair to AI, it's not terrible at predicting some of our bad behavior.
Right, right. Oh, I bet it's
Right?
getting better too.
It is indeed. But yeah, I don't disagree with you that it's super helpful in terms of the mundanity of the typical business life, which
Mm,
is paperwork, compliance stuff, and even some of the analytical stuff where you don't want to pour through a balance sheet to value an equity. It can
right.
help you do that stuff on a pretty quick basis, but it can't tell you what the inputs are necessarily, right? And that's sort of your point is that, you know your clients best, or I know, this company best in terms of, valuing that stock.
Mm,
The technology is going to give me some answer. It's just any answer. And if you ask it to give you another answer, it can do it just the same
right, right.
with the same level of confidence. So it's a little, no, it's a bit like a teenager behind the wheel of a car. They they have a
Yeah.
lot of confidence and very little experience.
No, I like that. I like that analogy. Okay, we'll table the AI stuff. It's fascinating. It's hard to stay away from, but returning to private equity.
Indeed.
Um, typical timeline. And
Mhm.
so I guess it varies a lot depending on the type of private equity firm, but then also too, returns have to be all over the place, varied year to year.
For
Like you
sure.
said, you're going to commit. You might not see a return on that investment, till way later. Maybe it's year three of a 6 year term or whatever it might be. Is
That's
that
right.
correct in how to think about it, or?
Exactly. So your typical commitment would be something like 10 years, right? That's sort of the target for a private equity fund life cycle. And so, as I mentioned, in the first three-ish years, they're drawing down that capital to invest in firms. They buy those companies, turn them around, spin them out, sell them. And by year 10 is when you start seeing some cash flows typically, years five, six, seven. But in terms of your overall dollar investment, let's say you invested, $10 million over the first 3 years, you're not going to really see 10 million plus until sort of years seven, eight, nine, 10, right?
Right,
Hopefully plus, right? That's the objective.
right, right.
So that's the typical pattern. Now, it really is a function of two things. The number one, the quality of the investment manager,
Mm,
um, and the economic environment in which that fund was raised. Right. So, for example, if you raise, and this is proven in the academic literature, if you raise a fund when the market's at a peak, right, when it's really easy for fund managers to raise money,
mm,
those funds tend to go on to underperform. Largely, if you think about it, it's like overpaying for a meme stock, right?
okay.
You're buying at the height, and
Right.
you're overpaying essentially. So you don't want to buy high, sell low, right? You want to buy low, sell high. So for funds that are sort of raised in a given year, we call them vintages, right? So any fund that is raised this year would be a 2025 vintage.
Okay.
Um, and it's going to have a certain characteristic in terms of performance, just sort of across all funds that are raised by private equity managers. Whereas in, years where markets where no one wants to invest capital, right? If you raised a fund, for example, in the wake of the global financial crisis, sort of 2010, right?
Right.
Those funds went on to perform much better, largely because they were buying low, right? Companies
Mm,
wanted to sell, other funds were trying to get out of things, right?
right.
So those tend to do better. So there's this sort of vintage effect in, over time as well.
So that's interesting. And in some ways, it doesn't clarify things for me when I look at it from a no, sorry, from what you said
Yeah.
was clear, but it doesn't clarify things for me from maybe I just don't have the sophistication or the intellect. But when I'm looking at it, it seems very difficult to value because
Hmm.
of the when did the firm start, right? How
Right.
the opportunity cost, right? Financial term for how much could this money have earned in another investment of equal risk or whatever it might be. And then it seems very convoluted and there's kind of a mystery to it
Hmm.
as far as benchmarking and valuing. Okay, so you commit this, and then so many years
Yeah.
later there's this, and then there's this fee structure of a 2 and 20, and okay, so
Yeah,
I get
so let's
yeah.
talk about that. I mean, I think you're kind of hitting at, the major challenge to private equity. And frankly, this is to any private investment.
Mm,
So I'll start with an analogy. Like, let's say you go and you want to buy a house. Well, it's not publicly traded. You don't know what it's actually worth, do you? Now, you know what the realtor wants to sell it for you, sell
right.
it to you for, right? That realtor, she or he's on the buy or on the sell side, right? They're trying to sell you something. And hopefully you have a buy side realtor who's trying to get the lower price.
Right.
Um, but again, it's an appraisal, right? It's just based on what we think it's worth relative to what it's traded in the past and relative to, everything that else that might be on the market or has sold recently near your house that looks the same.
Mm,
Right. And that's exactly how private equity is done, right? So you have a private equity manager who's looking for businesses, right? And when they go to buy businesses, they take a look at the business, cash flows, obviously,
mm,
the management quality of that firm, and they come up with some valuation of similar firms in similar industries that are about the same size, that have about the same age in terms of, been around 10 years or something like that,
mm,
and they apply some valuation. Now there's some give and take between the private equity fund manager and the business owner who's trying to sell
right.
about the right price, right? So there's this negotiated valuation. And when they buy that firm for X price, let's say it's $1 million,
Mhm.
it comes on the books of the private equity firm for $1 million, right? That's what we call the net asset value of that acquisition, if you will.
Mhm.
And then over time, the private equity manager is buying a bunch of businesses like that, right? Through a negotiated valuation process. Now, obviously, they have more sophisticated, but at the end of the day, it's still sort of, it's a guesstimation, right?
Mhm.
Educated guesstimation. I
Right.
don't want to downcast their
Yeah.
skills that much. But and then over time, they have a bunch of these businesses that are sitting on the private equity fund portfolio, and there's a NAV, a net asset value of all these companies in the portfolio. And that's what the private equity manager is reporting to the LPs, to the investors, right, on a quarterly basis. So there's sort of this quarterly mark to market of these underlying firms. Now, this is one of the great challenges is that the private equity manager every month has to apply some valuation to each one of these businesses. Okay. Is it still worth $1 million or is it worth like a little bit more? Right.
Right.
And
Right.
it's, yeah, exactly. Right. It's kind of thumb to the wind. I think it's about
Yeah.
a million, maybe a little more. Right.
Mm.
And so that's what the GP, the investor sees on a quarterly basis is like, oh, it's kind of the same NAV as last quarter plus a little bit more.
Mm.
Right. And then that's kind of how it is for the first X number of years until they start receiving distributions, right?
Okay.
The distributions might come through dividends that are paid from the firm, right? Or through a sale of those underlying firms.
Mm.
So that's when you start seeing actual cash. So you see kind of two valuations. You see some cash coming back to me, and then this net asset value. It's like the price of the stock, if you will, right?
Gotcha.
That's what they see. So there's not a lot of transparency in terms of what those firms are really worth. And so that's one of the knocks on private equity is that, well, you're not really marking these things like a public equity would be marked, right? And that's kind of where my paper comes in, is talking about how can we, rethink about how these are valued. Um, and so what we try to do in the paper is say, look, these mark to marks between quarters, it's really smooth, right? It's as
Mm.
if, you bought an Apple stock for $100, and then the next time you see the price, 3 months later, it's like $101. There's no volatility in the return,
Mm.
right? And so that's super attractive to investors, right?
Right.
They're
Right.
like, I would prefer to sleep at night. Thank you very much. So in some ways, they call this volatility laundering, right?
Okay.
Through private markets. Sometimes the fact that they don't see this volatility is a benefit to some investors, even though the true economic underlying fundamentals of a business are clearly tied to the overall economy, right? But
Mm.
you don't see that in these mark to markets that only occur once a quarter, and it's on an appraisal, right?
Okay. Interesting.
Yeah, so that's
So,
one of the great challenges.
okay, interesting. So, a couple questions follow up to that is so institutional investor, private investor, they can receive distributions through dividends, and
Mhm.
then at the end of the term, there'll be like the big kind of
Yeah,
settlement, right?
exactly.
And I guess that's where an investor would determine that's when they can finally determine their internal rate of return, right? Of
Correct.
what this all came out to be. Now if let's say there wasn't this smoothing out of returns and things started to look shaky, once you're committed, or is there a surrender
Mhm.
charge like insurance where after so many years there's a penalty and you can pull out but there might be a fee? Is that a thing?
Not usually. No,
Okay.
I've never heard of it. That's not to say it doesn't exist in some funds. No, you're committed. It's a legal contract that you're committed to these funds. Now, that's why there's been this huge growth in the secondary markets, right?
Hmm.
Right. So you have, these large endowments, especially lately, these educational endowments are trying to pull out of their commitments to private equity to put more cash, frankly, in their underlying schools, for example, because they're concerned about potential tax hikes. And so you'll see that they're actually trying to access these secondary markets, basically saying, "Hey, we'll sell our commitments to a similar buyer who's interested. We'll take a haircut, so there will be typically a haircut
Hmm.
of X%. Not depends how motivated they are in
Right, right.
terms of the potential upside that they have to give up. But the GP also has to agree to it. The actual private equity fund manager. You know, like the Harvard endowment is not just going to go sell their, commitments to some willy-nilly retail investor, right?
Right.
The GP is going to say, no, we're not going to do that. And the GP also has some interest to keeping a relationship going, frankly,
Hmm.
with investors too. So, it's trust in a two-way form, right?
Right.
And it's a two-way trust business for sure.
So can do these private equity firms when they're pitching or they're starting like a vintage, like you said,
Mhm.
um, with such a long horizon and not knowing, maybe they don't know what opportunities they're actually going to come across in that period.
Mm, right.
How do they market it as far as like an expected rate of return? And then also also to that point, at the end of this term, do institutional investors then benchmark just to other private equity firms during that period? Is that common?
Yeah. So in terms of the marketing, for firms that are new at launching a fund, it's really just, hey, here's our background. Here's where we've worked before. We've had successes at those firms. They might be able to, call on some prior performance of the prior firms they worked at,
Mm,
but really it's a promise at the end of the day. And so what they'll typically say is, here's our target return, right? We have a hurdle rate of return of 30%, right? That's something you typically hear, particularly in venture capital, it'll be sort of like 35%. Your typical buyout fund might be sort of 20%, right?
okay.
Or it might be relative to some market multiple, right? The S&P 500 plus 5% or something like that
Okay.
over the full business cycle, like 10 years, right? On an annualized basis, right? That's the typical, pitch in
Mm,
terms of raising funds. For larger private equity firms who already have a history of success, it's much, much easier for them to raise funds.
mhm,
And, there's academic research that suggests that that's not an accident. They actually tend to outperform over time, right? That is to
mm,
say, those private equity managers who have outperformed in the past, there is performance persistence in the private equity realm, right? That is, they continue to perform well in the future, which is not the case in public markets, right? Your typical mutual fund, there's really no, predictive ability
mm.
based on past performance.
Gotcha.
Um, yeah. So there was a second part of your question and it just slipped my mind
Oh,
now.
the so at the end here, how does an institutional investor sort of figure out we did well or like how we did at, you know
Oh
what I
yeah, the
mean?
benchmarking, the
Yeah.
the performance measurement. So you mentioned this term earlier, internal rate of return, IRR.
Mhm,
So this is a form of return measurement, which is very different in many ways than what we think of in terms of public markets, right? So in public markets, we look at we call them returns, right? And it's really technically what's called a dollar weighted return, right? How much money I put in, got some returns, I pull my money out. Internal rate of return is a time weighted return. It's sort of a function of how much did I earn over what period of time, right? So in some ways, it's kind of like your speedometer in your car, right?
mhm, mhm.
I'm doing 60 miles per hour. I'm getting 20% per year, and I've been in it for 5 years, right? So it's a 5 year return, right?
Right.
The problem with that measure is that over as your time period extends, the IRR falls if there's no more cash flows, right?
Mhm,
Which might seem obvious, but oftentimes when firms are raising capital for a new fund, they typically raise it in the middle, right, of the life cycle of their current fund.
mm,
So the returns look pretty good.
I
But
see.
that can drag on forever, getting rid of those last, laggard firms that they can't sell in the portfolio, right? And so the
Right.
IRR could be dragged down over time from that. But there's other ways of measuring private equity performance. They typically also report something called multiples of invested capital. And there's a
Mhm,
couple other acronyms in there, but basically the idea is, how much did I put in? $10 million. And how much did I get out at the end? $20 million. So I have a
right.
2x multiple, right?
Right.
And clearly that'll change over time as well. So early in the years, you have a negative multiple because you're not getting any cash flow. And then over time, that becomes more positive. And your goal, of course, is to be well north of one, right? You want,
Right.
a rate of return well north of one, particularly on an annualized basis.
Mm,
In terms of benchmarking, right? Um, how does, the Hawaii employee retirement system benchmark their private equity investments, right? Um, at least formally, typically what they'll do is something called a public market equivalent, right? So this is born out of some research in the private equity field 20-ish years ago. In well, 30-ish now these days. I'm getting older. And basically what it does is compare the private equity fund's performance to the public market in a very simple way, right? So remember how I talked about getting those capital calls after you've made that commitment, and they say, "Hey, we found a firm, give us $1 million," and then a year later you get another call. Okay, now we need 5 million. Now imagine instead when you got those capital calls, you put it into the public markets,
Mm.
right? So it's sort of a time equivalent rate of return based on when you're putting money in, except you just, instead of putting it in this private fund, you're going to put it into the public markets. So you can kind of figure that out, right? If I'm getting a call every 6 months, equal $1 million payments over the first 3 years, well, what would be the equivalent if I did that in the public markets,
Mm.
right? About a low cost index ETF, for example.
Right.
That's what a public market equivalent it is. And so that's kind of a standard benchmark um, that we would use. And of course, we're human. We see public markets all the time. So of course,
Right.
we're also going to look at the S&P 500
Sure.
plus maybe some liquidity premium. Like, I want to be whatever 3% above the S&P 500, like at
Mm.
least, mentally. Um, to your other point, though, they will also look at other peer private equity funds, right?
Mm.
So there's, these large commercial data sets where you can see what, other private equity funds are doing in terms of performance. Um, but, depending, it really depends on the sophistication. But in fact, my old firm, Cambridge Associates, produces an index, right? A private equity performance index every quarter, right? So that's also something that investors can use. And other commercial data set providers like Preqin and PitchBook also put out that sort of industry level performance information.
Okay, interesting. And then I guess another thing from the institutional investor perspective, it appears from my vantage point, private equity offers two things. One,
Mm,
there's the potential for higher than market returns, right? Your public market returns.
indeed,
But then two, I would imagine some of these institutional investors, when they're designing a portfolio, it probably offers a fair amount of diversification in that I would imagine private equity firms, some do better actually when markets go down if they're in the business of maybe acquiring struggling businesses at the bottom.
for
And
sure.
so it might not be correlated. So I'm sure it offers diversification as well, like a two-edged sword there for them.
It does indeed, right? That's exactly, one of the main reasons investors like the asset class is it does provide diversification, which, sometimes it's not always good.
Right, 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 right.
So
That's that's a
in terms
great
of
point.
performance, but
No, no,
diversification is about correlation risk, right? Not
right,
necessarily performance risk.
right, right.
So
No, that's a
timing's
great
everything.
point. Yeah.
Yeah, that's exactly right. And yeah, to your point, private equity has outperformed. Most academic studies show, including ours, that they tend to outperform
Mm.
public market equivalents, as it were, right? Um, but it's really fund by fund specific. If you have access to the top quartile of private equity funds, you can pretty much sleep well at night. But the remainder, it's hit or miss, much like any mutual fund would frankly be. It's not
Right.
like you're going to lose your shorts necessarily unless you're in the worst one. Um, but you might not get the returns you hope for, depending upon which fund you're invested in. Um,
Okay.
so yeah, there's clearly diversification benefits for sure.
Okay, great. I want to be cognizant of your time here. I appreciate you coming
Yeah, of
on.
course.
I guess as we kind of head towards wrapping this up here, just broadly speaking, again, the landscape of private equity
Mhm.
over the years, has is there any trends to where we are now, and any insights as to where private equity is heading in the future? Is it whether it's the number of firms, the types of firms, anything you see there?
Yeah, I mean, there's a lot of changes, particularly over the last decade or so. Number one, there's been massive growth in terms of assets coming into the private space.
Mm,
Um, Now, there might be many sort of big picture reasons why that's the case. And it could be the case that, firms no longer want to go public or stay public because, the regulatory requirements can be burdensome, particularly for small companies. It's costly to, you know, put out, quarterly filings and SEC filings, that is, right?
Sure.
And so there's been massive growth in terms of investors who want to invest in private markets in terms of providing the supply of capital, as well as businesses who prefer to stay private for longer, right? So the demand for capital is there.
Hmm.
Other evolutions include the broader access that we were talking about,
Hmm.
particularly to retail and high net worth individuals like interval funds, BDCs, or even platforms that kind of open the door for retail investors, secondary markets too, right?
Hmm.
You're seeing a lot longer horizon on some of these funds. You know how I said that sometimes it's like 10 years?
Right.
Well, there's been a huge increase in what are called continuation funds. Right. So if you have a fund that's run by Apollo and they have like five businesses in there that they really still like, but don't want to sell, or there's not a buyer willing to pay the price that they're looking for,
Hmm.
well, they might launch a new fund and put those businesses in that fund to create liquidity for the existing investors, right?
Hmm.
So those are continuation funds. So you've seen a lot more of that, which, I think that's not necessarily a bad thing. And, typically you want to keep the good ones, right?
Right. Right.
And pay off the investors in the meantime. Um, you're seeing a fair bit more in terms of not not just growth in terms of assets under management, but here's an interesting sort of big picture perspective is that, you know, 20, 30 years ago, there was something like 5,000 publicly listed US stocks,
Hmm.
right? Now we're looking at like 3,000. So of the publicly listed stocks in the US, there's fewer of them and they're much larger, right? So we just saw Nvidia, for example, go above the $4 trillion market cap last week.
Hmm.
Um, and so that's sort of also evidence of, all this extra interest in the private markets. Now, let's be very clear, the private markets are still massively much smaller
Hmm.
than public markets, right? You mentioned sort of 6 trillion in private equity, which is, roughly true. It's, the public equity markets are in the sort of $120 trillion range,
Hmm.
right? So still a very small slice of at least the market capitalization of the public equities globally. Other things you're seeing, is sort of like more thematic kind of funds or tech-enabled funds. Anytime you have these these sort of buzzwords, you'll find funds that are trying to capitalize on that. So obviously, be a little wary of those types of funds that are capitalizing on anything AI, tech-enabled, or sort
Right.
of thematic in that regard.
Sure.
Yeah,
Well, fascinating. I think I could talk to you all day.
always a pleasure.
It's been a great conversation. I really appreciate you coming on, Dr. Trey Spilker of Shidler College of Business. Any final thoughts or?
No, no, no. I mean, as with any investment, product, buyer beware, do your homework.
Right.
And in the private equity space or private market space, there's a lot more homework you have to do than in the public sphere, given the limited amount of information. Yeah.
Great. Trey, thanks so much for your time. Appreciate it.
Thanks, Jason. It was a pleasure.
The opinions and statements presented on this show are for general information only and are not intended to provide specific advice or recommendations. Never make any investment or financial decisions based on information offered on this show without first consulting your financial, legal, or tax advisor. All economic and performance information mentioned on the show is historical in nature and is not indicative of any future results. All indices mentioned on this show are unmanaged and cannot be invested in directly. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Lastly, all opinions expressed by Jason Katita and any guests on the show are solely their own opinions and do not reflect the opinions of or are endorsed by Toba Financial. For Jason Katita, investment advisory services are offered through Toba Financial LLC, a registered investment advisor offering advisory services in the state of Hawaii and in other jurisdictions where exempt from registration.